Open with a chart of the Roman Denarius, the Spanish real, and the British pound sterling. Each line trends to zero. Historians will mark 2026 not as the year America collapsed, but as the year the mathematics of empire became irreversible, not with a war or a market crash, but with a silent triple-point convergence of fiscal, demographic, and geopolitical clocks that have measured the lifespan of every superpower in history. These are nonpartisan, unavoidable cycles, and all three are set to alarm within the same 18-month window. Here are the three clocks, each with a 2026 expiry. Clock 1, the fiscal doom loop. The Congressional Budget Office, INDE's own long-term model shows 2026 as the inflection point where mandatory spending plus net interest on the debt permanently exceed total federal tax revenue. The government becomes a machine that exists solely to pay its bills and its promises, with nothing left for anything else. Clock 2, the demographic cliff. The 2026 Social Security Trustees report will confirm the trust fund's effective depletion. This isn't about bankruptcy, it's about political reality. It forces immediate 23% benefit cuts, or equivalent tax hikes, a thermonuclear political crisis. Clock 3, the geopolitical pivot. This is the hardest deadline of all. 2026 is the stated target for the operational Russia-China and BRICS plus alternative trade and financial system. It is the date the world's largest energy producer and consumer intend to fully bypass the dollar. This convergence is the end of the Sterling American exceptionalism premium that has been priced into every asset you own. It means the end of perpetually cheap capital, structurally calm markets, and a universally strong dollar. What replaces it is a world of volatility, capital scarcity, and a brutal fundamental repricing of everything from treasury bonds to tech stocks. The elites see this triple calendar. They are quietly building financial and physical lifeboats, diversifying assets, obtaining second passports, moving capital. They are acting on the data, while the media narrative still insists the ship is unsinkable. This is the ultimate betrayal hidden in plain sight. But to understand why this time is different from every doomsday prediction, you must see the single, non-cyclical catalyst that has accelerated all three clocks. Let me show you the 2024 policy error that lit the fuse. Look at this chart from page 12 of the CBO's 2024 long-term budget outlook. This is the official, nonpartisan forecast. Watch the two lines. The blue line is federal revenue, the red line is spending. See where they are in 2024? They're already apart. Now follow them to 2026. Circle that year on the x-axis. This is the moment they permanently, irrevocably diverge. The gap doesn't just widen, it becomes a chasm, exploding upwards off the chart in the following years. The red spending line goes vertical. Now, zoom in on the fine print. Right here, the report includes a critical footnote. Let me circle it for you. It reads, beyond 2026, the assumptions underlying this projection become increasingly unsustainable. That is the most alarming sentence ever written by a government accountant. Unsustainable is their code for mathematical collapse. This shreds the consensus narrative. You're told we have a debt problem, but we can grow or tax our way out over the next decade. The reality in this chart is that the window for gentle, gradual solutions closes in 2026. After that point, the debt trajectory becomes a literal vertical line. To bend that line back would require austerity, trillions in spending cuts, or tax hikes, on a scale that would trigger immediate social and political upheaval. It is politically impossible. The math now has a veto over politics. And here is the catastrophic coverage gap. Every major outlet reported this CBO document as another sober debt warning. A one-day story. Not a single mainstream analyst connected this 2026 fiscal inflection point to the 2026 Social Security demographic cliff, or to the 2026 geopolitical deadline our adversaries have set for their dollar alternative system. They are reported in isolated silos: budget news, retiree news, foreign policy news. But history doesn't care about our news cycles. It sees converging lines. One unsustainable clock is a serious problem. Two synchronized clocks is a systemic crisis. But three independent, nonpartisan cycles, fiscal, demographic, geopolitical, hitting their terminal phase within the same 18-month window, that is not a coincidence. That is the fingerprint of history. It's the identical countdown sequence that started in the late Roman Republic, that peaked in Edwardian Britain, and is now flashing red in Washington. The empires didn't fail when they ran out of soldiers. They failed when they ran out of time and trust, trapped by converging obligations they could no longer meet. Let me show you the side-by-side timeline. This is not theory. It is a replay. The most precise historical mirror for America's 2026 convergence is not Rome's fall, but the British Empire's interwar crisis from 1918 to 1939. That was the two-decade moment the imperial system became mathematically, financially, and geopolitically untenable, while its leaders desperately pretended otherwise. Let's align the parallels. The fiscal anchor. Britain was crippled by unpayable WWI debts, its gold reserves depleted. America is anchored by unfunded liabilities and pandemic-era debt, with its strategic financial reserves, global dollar demand, now under direct assault. The currency strain. Britain strained to uphold the sterling gold standard, the bedrock of its global prestige. America strains to uphold the petrodollar system, the bedrock of its financial dominance. Both systems require a constant inflow of capital and confidence that is now draining away. The military overstretch. Britain's yes Navy could no longer afford to single-handedly police global trade routes against rising challengers. America's military is stretched across the globe, facing peer competitors for the first time in generations, with a defense budget increasingly funded by debt. The rise of the challenger. Then it was the ascendant, debt-free industrial might of the United States. Now it is the combined economic and resource mass of the China-Russia axis, actively building alternative systems. The British elite, as historian Paul Kennedy wrote in The Rise and Fall of the Great Powers, suffered from imperial overstretch, when a nation has global interests and obligations are far greater than its power to defend them all simultaneously. They clung to the empire project for 20 years after it was financially bankrupt, leading to the disastrous, punitive peace of 1919 and the inevitable slide into a second catastrophic war. The final outcome was the formal, orderly transfer of financial power, the 1944 Bretton Woods Agreement, which crowned the dollar as the new global reserve currency. We are now in that same interwar period, the decades of denial between the moment an empire becomes unsustainable and the moment a new system is born. The 2026 deadlines are our 1919 Treaty of Versailles, the point of no return that future historians will pinpoint. But Britain had one advantage we don't, a benign, friendly successor. Our challengers are not. This changes the final outcome from transition to confrontation. Let me show you the one chart that proves the confrontation is already priced in by the smartest capital on Earth. Separately, these are three massive problems, but they don't operate separately. They connect into a single, vicious trifecta feedback loop that becomes self-sustaining after 2026. Here's how the loop closes. 1. The fiscal tide goes out. 2026, CBO cliff. The U.S. Treasury must borrow trillions just to pay for past promises, Social Security, Medicare, and the interest on existing debt. This massive borrowing crowds out productive investment in the private sector, slowing economic growth. 2. The demographic wave hits. 2026 Social Security cliff. The peak of the baby boomer retirement tsunami hits, drawing down the national pool of savings and maximizing entitlement spending. This reduces the domestic capital available to buy the Treasury's new debt. 3. The geopolitical escape valve closes. 2026 Dedollarization. Foreigners, who historically funded our deficits by recycling their trade dollars into treasuries, now have a viable alternative. They park their trade surpluses in gold-backed systems or other assets. Their hunger for U.S. debt diminishes precisely when we need it most. Here's the simple analogy. America is a company that's funded its growth for decades with a beloved high-limit corporate credit card, global demand for U.S. treasuries. In 2026, three things happen simultaneously. 1, its payroll obligation doubles, entitlements boom. 2, its sales growth slumps, aging population, weaker growth. And 3, the bank cuts its credit limit and raises its rates, foreign buyers retreat. Insolvency isn't a single event. It becomes the new permanent operating reality. This triggers the ultimate amplification channel, the return of the bond vigilantes. When the primary buyer of debt shifts from foreign central banks, demand-driven, to the Federal Reserve, money printing, it signals a loss of confidence. Markets force interest rates higher to compensate for risk, which makes the debt burden even heavier, which requires more printing. This is the doom loop of fiscal dominance, where the central bank loses control to the Treasury's borrowing needs, guaranteeing a currency and inflation crisis. Look at this triple axis chart. Line 1, U.S. debt to GDP soaring past 130%. Line 2, working age population growth turning negative. Line 3, foreign holdings of U.S. debt as a percentage, plateauing and now falling. All three lines cross from problematic into the terminal danger zone right around 2026. This isn't fringe analysis. The Bank for International Settlements, BIS, the central bank for central banks, has repeatedly warned that advanced economies face a critical risk of fiscal dominance in the latter half of the 2020s. They are describing our 2026 convergence. They see the loop closing. But this loop creates one inevitable, non-negotiable outcome for your wealth. Let me show you the forced transfer it mandates. This converging storm will not just hit the economy. It will sequentially dismantle the financial pillars of your life, from your portfolio to your pension to the very social contract you rely on. Level 1, the investor's dilemma, 2024-2026, the end of diversification. The foundational rule of modern investing, that U.S. stocks and bonds move inversely, will shatter. In a fiscal funding crisis, rising Treasury yields, crushing bonds, will also crush stock valuations by raising the discount rate for all future corporate earnings. Your 60/40 portfolio will see both sides fall together. The buy the dip mantra, dependent on endless cheap capital, will fail spectacularly. The entire playbook of the last 40 years becomes obsolete. Level 2, the saver and retirees confiscation, 2026 to 2028, the era of financial repression. When a government is drowning in debt it cannot openly default on, it resorts to financial repression. It forcibly channels capital to itself. How? By keeping interest rates artificially below inflation, it systematically erodes the real value of your cash and fixed income savings. Your safe money is silently confiscated. Pension funds will be encouraged or mandated to buy more treasuries, locking them into low, losing returns. Your safety becomes their funding mechanism. Level 3, the citizen's broken contract, 2028-2030, the end of the public good. The unthinkable becomes bipartisan policy. Means testing for Social Security benefits you paid into. Steep Medicare copays and coverage cuts. Inflation-adjusted tax brackets are left to lag, resulting in brutal bracket creep. A massive stealth tax increase on the middle class. A social contract forged in the 20th century tiers, pitting generations and income groups against each other in a zero-sum fight over shrinking resources. Level 4, the heir's inheritance, 2030 plus, a lower trajectory America. The ultimate outcome is a nation with a permanently higher cost of capital. Expensive money means less venture funding, fewer startups, stalled infrastructure, and chronic underinvestment. The American economy shifts to a lower, slower growth trajectory. The American dream ceases to be a national promise and becomes a geographically locked or financially unattainable relic for most. Your children inherit a less dynamic, more unequal, and fiscally constrained society. Here is your mathematical proof. Open a compound interest calculator right now. Plug in your retirement savings goal. Assume the historical 7% annual return. See what age you can retire. Now, change that expected return to 3% to reflect the higher cost of capital and lower growth of a fiscally dominated economy. Watch in real time as your retirement age shifts from 65 to 75 or 80. That is not a market cycle. That is a change of civilization. It's the direct result of the 2026 convergence. But this future is not equally distributed. A specific class of assets is being positioned to not just survive, but thrive in this new environment. They are the modern equivalents of owning land during the fall of Rome. Let me show you the 3 categories. The speed of this crisis is not set by politics, but by a single terrifying accounting metric, the debt service to revenue ratio. This is the percentage of all federal tax income consumed solely by interest payments on the national debt. Watch this number. When it crosses 30%, it signals point of no return stress. The CBO projects, we hit it in the latter half of the 2020s. That's the accelerator. Every tick higher forces more desperate choices faster. The catalysts that will make this abstract number a market reality are already scheduled. The 2024 election. The outcome is almost irrelevant to the math. No conceivable electoral mandate will be for the trillions in tax hikes or spending cuts needed to alter the 2026 trajectory. The political system will remain paralyzed, guaranteeing the cliff is hit. 2025. Taper tantrum 2.0, the real one. This is when the Federal Reserve S attempt to normalize its balance sheet will collide with the Treasury. S need to issue a flood of new debt to fund the pre-2026 gap. The bond market will revolt, spiking long-term rates in a violent, unstable repricing. This is the O-T moment for institutional capital. 2026, the X date for the trifecta. This is not a debt ceiling deadline. It's the year the 3 converging cycles make the unsustainability of the current model a daily operational crisis for Washington. It's the year politics finally surrenders to mathematics. Watch for this specific threshold point. When a major U.S. treaty ally, Japan or Saudi Arabia, announces a meaningful non-symbolic reallocation of its sovereign wealth fund or reserves away from dollar-denominated assets. This won't be a press release. It will be in an annual report footnote. A 5 to 10% shift into direct infrastructure, European equities, or gold. That is the institutional sell signal that cannot be recalled. This creates your critical window, right now through 2025. This is the last period of optionality, the final time you can calmly and strategically diversify the sovereignty of your assets, their geography, their currency, and their custody. Once the 2025-2026 catalysts hit and the crisis management phase begins, the rulebook changes. Capital controls, wealth taxes, and forced asset repatriation become possible policy tools. Your freedom to move will be the first casualty. But to diversify intelligently, you must understand what the lifeboat assets have in common. Let me show you the one principle uniting Swiss francs, Singapore real estate, and Texas farmland. In a systemic transition, conventional portfolios fail. The goal shifts from maximizing returns to preserving optionality and sovereignty. Your wealth must be positioned in assets that retain utility and value, regardless of the fate of the U.S. dollar or treasury market. Here is the three-tiered framework. Category 1, sovereignty assets outside the system. These are assets that exist independent of any government's ledger. Asset 1, physical gold and silver in private, non-bank custody. This is the foundational hedge. It is not an ETF or a futures contract. It is bullion you control, stored outside the banking system. For 5,000 years, it has been the final asset, standing when faith in political promises evaporates. It is the direct antidote to financial repression. Asset 2, productive land and direct commodity exposure. This means farmland, timberland, or shares in essential commodity producers, energy, fertilizer, critical minerals. These are real things the world needs, food, energy, materials, whose value is intrinsic. Their price may fluctuate, but their utility does not vanish with a currency crisis. Category 2, geographic and fiscal arbitrage. Move capital to where the demographic and fiscal winds are at your back. Asset 1, deep value in strong allied nations. Look for undervalued equities in countries with better demographics and fiscal discipline than the U.S. Think certain Japanese industrial exporters or South Korean tech manufacturers. You are buying world-class companies whose home currency and government balance sheet are not in structural decline. Asset 2, access to sovereign balance sheets. Invest, where possible, in the economic engines of nations with massive fiscal surpluses and commodity wealth, akin to owning a piece of the Norwegian sovereign wealth model. This can be done through ETFs focused on regions like the Gulf Cooperation Council, GCC, or select resource-rich nations. Category 3, the strategic hedge, for sophisticated capital only. Trade, long volatility, long-tail options. This means purchasing out-of-the-money put options on major indices, SPY, or directly on long-term treasuries, TLT. These are black swan insurance policies that pay out massively during a systemic crisis. Warning. This is premium burning, complex, and should only be deployed with true risk capital. It is insurance, not an investment. The essential allocation warning. This framework is not about abandoning America. It is about recognizing a brutal fact. For most investors, over 90% of their net worth is tied to a single geopolitical and financial system now facing a documented convergent stress test. Prudent diversification is no longer a growth tactic. It is a capital preservation strategy. A reasonable starting point is to allocate 20 to 30% of your portfolio outside the direct reach of the US dollar and Wall Street financial markets. This isn't pessimism, it's the portfolio equivalent of not storing all your food, water, and fuel in one basement. But there's one more crucial layer. The digital dimension of this new system is already being built, and it presents its own unique threat and opportunity. Let me show you the digital lifeboat and the digital prison taking shape. A converging mathematical reality that redraws the global map is not on your nightly news. The silence is deafening, and it's deliberate. This is the ultimate emperor's new clothes story. But the emperor isn't a person. It's an 80-year-old global system, and the entire court depends on pretending the robes are still magnificent. The structural taboo. The political establishment, the financial media, and the corporate leadership class are all funded by and are pillars of the current order. Their careers, revenues, and prestige are tied to its perpetuation. Discussing its potential end is not just controversial. It is career and access suicide. It breaks the foundational narrative that their entire world is built upon. The psychological blind spot, shifting baseline syndrome. We have only ever known a world with a dominant, financially secure America. We assume this is the natural, permanent state of the world, not what it truly is, a historically anomalous, post-boom period that is now reaching its actuarial end date. Our baseline for normal is a fleeting moment of peak dominance, making the coming shift feel impossible. The institutional manage the decline doctrine. The informed elite are not trying to avert the 2026 convergence in public policy. Their plan is to navigate it privately. Their preparations, accumulating non-reportable assets, obtaining alternative residencies, hardening their wealth against systemic confiscation, are conducted in silence. Their public statements are a steady drumbeat of resilience, strength, and continued leadership, designed to maintain social order while they quietly build lifeboats. History's precedent is precise. In 1788, the French aristocracy debated minor tax reforms, while the royal treasury was utterly bankrupt. The notion that the Ancien regime itself could vanish was unthinkable, until it did in a matter of weeks. The same unthinkable is now a spreadsheet cell in a CBO report. The real analysis isn't on Bloomberg. It's in history department seminars, at closed-door hedge fund conferences on geopolitical alpha, and in the long-term risk assessments of the intelligence community. They are connecting the dots. The public narrative must keep separate. But the most profound dot of all is digital, and it changes everything about how this transition will unfold. Let me show you the central bank digital currency trap in the escape hatch. We are not witnessing a simple shift. We are witnessing the physical and digital construction of a new world operating system, built parallel to the old one. This is the modern parallel, the multipolar world infrastructure project. While Washington debates, Beijing, Moscow, and their partners are laying the cables, launching the satellites, and writing the protocols for a system that doesn't need America's permission to function. Let's analyze the similarity to past empires. Pax Britannica, powered by the Royal Navy, global telegraph cables, and sterling-based trade. Pax Americana, powered by the U.S. Navy, the SWIFT financial network, and the petrodollar. The emerging network is being powered by Chinese naval expansion, the cross-border interbank payment system, CIPS, the digital yuan gold hybrid, Beidou satellites, and undersea cables bypassing U.S. hubs. They are building a complete sovereign stack. But the key differences are what make this transition uniquely dangerous. Digital speed. A challenger can now build a rival to SWIFT in years, not decades. Capital flight can happen at light speed. Asymmetric leverage. The new challengers don't need to match the U.S. Navy ship for ship. They seek dominance in cyber, economic coercion, and control of critical mineral supply chains, asymmetric advantages that neutralize traditional military power. Internal fracture. Britain in 1914 had deep class divisions, but a coherent ruling class and imperial mission. America in 2024 is in a state of unprecedented internal, political, and cultural civil war at the precise moment of external reckoning. A divided house cannot stand. This leads to the ultimate risk assessment: miscalculation. History shows a declining power, cornered by internal crises and collapsing finances, is at its most volatile and dangerous. The 2026 breaking point dramatically increases the probability of a major external conflict over Taiwan, an escalation in Ukraine, or a new flashpoint, as a desperate diversion or a final gamble to rally domestic support and assert fading control. Your monitoring metrics must now be strategic. U.S. Treasury auction tail sizes. When the high yield accepted is far above the expected yield, it signals collapsing foreign demand, a direct measure of de-dollarization in real time. U.S. strategic petroleum reserve levels. This is a crisis gauge. Rapid drawdowns signal preparation for conflict or severe market disruption. BRICS bilateral trade agreements. Scour the legal text for the clause, settlement in local currencies, excluding the use of a third-party currency. That is the kill shot. The final, most personal layer of this new system isn't a battleship or a pipeline. It's a line of code that can directly control your access to the digital economy. The CBDC trap is being set, and the time to understand it is now. You're no longer just an investor or a citizen. You're now a student of the longue durée, the long arc of history that bends beneath the noise of daily headlines. Most people are trapped in the news cycle. You're learning to see the cycle of history itself. This perspective is your most valuable asset. Turn this insight into action. Take these 4 steps. Step 1. The 60-second data immersion. Go to the Congressional Budget Office website right now. Find the latest long-term budget outlook. Scroll to the key chart. It's on page 10. Don't just glance. Find the year 2026 on the x-axis. See where the lines violently diverge. This is not an opinion or a prediction. It is a projection based on current law. The math is the message. You have now seen the primary source countdown. Step 2. The strategic share. Pass this analysis to one person whose intelligence you respect, someone who understands either deep history or hard markets. Use this precise title. The 2026 American inflection point history warned us about. You're not spreading doom, you are sharing a framework for understanding the decade ahead. Step 3. The community diagnostic. Comment below with your answer to this. Which of the 3 converging clocks do you believe will be the first to visibly crack? Debt, demographics, or dollar? And what is the one asset you already own that exists outside the U.S. financial system? This collective intelligence is our early warning network. Step 4. The critical serialization. Subscribe and hit notifications. In my next video, I will reveal the 3 specific publicly traded companies that are the essential picks and shovels for building the new multipolar world. These are not speculative plays. They are the firms constructing the financial pipes, physical infrastructure, and security architecture of the post-2026 order. This is how you invest in the transition, not just hedge against it. The final warning is this: empires don't end with a bang on a specific day. They end with a whimper over a critical decade. As the smart money quietly exits, the institutions slowly rot from within, and the people are left holding devalued paper, wondering what happened. Your primary task is not to stop the tide. It is to see it coming, understand its shape, and build your arc according to the new realities. You have the map. The choice to navigate is yours.